We'll start with the first question. The first question is about Delta Limited. So Delta Limited is an Indian company. So this Delta Limited is an Indian company which is basically declared a total income. So he has declared a total income of 2,100 crores computed in accordance with the Chapter 4D. That is, Chapter 4D is your computation of income. So your business or profession is discussed in 4D. So before making primary adjustments. So what exactly is primary adjustment? It's typically relating to, in transfer pricing, we had said there are one of the adjustment which talks about primary adjustment is discussed in section 92 CE. So that's what is discussed here. So in this particular section of 92 CE, what happens is the provision as such is whatever adjustments that is being taken care, will be typically an adjustment has to be provided in the books of account. So when you say primary adjustment, there is a transfer pricing adjustment due to an arm's length price, difference in arm's length price. Let's say my transaction was, what has happened is around 50 crores, but what is supposed to be the primary adjustment is 60 crores. So I'll have to adjust my books of account with 10 crores. This can either happen as suo motu, that is I myself can work as this primary adjustment, or I can look for the assessing officer, the TPO, the transfer pricing officer during the time of assessment. He may also adjust this particular situation. So the first set of this is called primary adjustment. That is, which is happening either suo motu by the assessee or what you call it is from the side of the transfer pricing officer, the assessing officer. He can also make this primary adjustment. So this adjustment, for this adjustment, there is a concept of secondary adjustment specified in section 92 CE. So this 92 CE provides about your particular situation where there is a primary adjustment, either suo motu or by the transfer pricing officer, for which what is supposed to be meant by the transfer pricing adjustment. So when I say the transaction is 50 crores, the arm's length price is 60 crores, I'm adjusting my books with 10 crores. So which means this 10 crores must be collected from the assessee. So that adjustment is called secondary adjustment. It is discussed in your primary adjustment, that is section 92 CE. Now, in this particular thing, that is your 2,100 crores computed in accordance is there. So what before making primary adjustments? Now, when this is required in respect of the loan transaction with Alps Inc. So this particular transaction is basically what has happened is there is a loan transaction with a company called Alps Inc. in Switzerland for the year 31/3/2022. So this is the broad understanding of the transaction. That is, there is an Indian company which has made around 2,100 crores before making any primary adjustment. What for a primary adjustment is required? There is actually a loan from a particular company in Switzerland that is in the year 31/3/2022. Now, this 31/3/2022 is what we are calling as the probably like called as the period in which they're talking about. So this period, that is 31/3/2022, is what you're trying to call as the year end that we are talking about. Now, what is the actual transaction? The transaction is Alps Inc. Alps Inc. is basically advanced loan of amount 350 crores, euro of 350 crores has been lent to Delta Limited at an interest of 9% per annum. So that is the interest rate that's provided. So they've given it on 1st April 2021. So this is what is the transaction. Now the total book value of the assets of Delta Limited was rupees 60,000 crores. So we need to see why is this important? Why is the value of fixed assets being given? That is 60,000 crores. Why is it probably given is what we need to understand. So they're saying that the book value of assets is 60,000 crores. Assume that the amount of interest is basically at 9% per annum, and it is payable to Alps Inc. They're saying that the total interest cost paid to Alps Inc. or the total interest does not exceed 30%. Why is this important? This is important because this 30%, there is also a section which is 94B, which talks about interest adjustment. So whenever there is an interest payment more than 30% to the associated enterprises, then automatically So this 30% will automatically be the limit, maximum interest that can be actually paid. So that's what this particular thing is about. So then they're saying that another Indian company, that is this Alpin, has also lent loan at 7% per annum to another Indian company in financial year 21-22 itself. So they've given a comparison saying at this. So the euro of this is 20 euro of per euro is around 88%. So we are required to examine whether the transfer pricing provision would be attracted and so on. And we also wanted to understand that whether this primary adjustment should be made, that is regarding primary adjustments, what should we take, that is in transfer pricing provisions, we have to understand this provision. So first thing is we need to understand that whether transfer pricing provisions would be applicable. Then we need to understand whether there is any adjustment that's need to be made in respect to them. And they're also asking us to explain about the secondary adjustments. So we need to calculate whatever the additional income tax liability because of this secondary adjustment. So these are the questions. So typically, as we said, things that we need to understand is the primary adjustment. The primary adjustment. The first thing is we need to understand what exactly is primary adjustments. Then we need to understand what exactly is secondary adjustment. Whether this particular transaction will be called as an associated enterprises or not. These are the things that we need to basically understand from this question. For the first question, that is whether they are associated enterprises or not. So for that purpose, if you actually go back and understand in 92A, which discusses about associated enterprises, there are certain transactions that are actually called as associated enterprises directly. That is, when you have some influence on management, control, or capital. If you have some influence on these three things on another organization, either directly or indirectly, in that case, this automatically becomes it becomes an associated enterprises. This is the direct, that is, it is an associated enterprises. In some cases, you also call a situation where they're called as deemed associated enterprises. So what do you mean by deemed associated enterprises? Deemed associated enterprises is basically, there are various categories. The thing that is relevant here is if loan provided by one particular entity is more than 51%. If it's more than 51% of this particular thing, then this 51% of the book value loan provided is more than 51% of the book value. In case if it exceeds that, then they will be treated as an associated enterprises. So we'll go back to the question. The total loan amount is euro of 350 crores, whereas the book value is 60,000 crores of that particular entity. Now this 350 crores, we'll have to use the exchange rate of 88 and understand what is the total loan amount is involved. So that is what we are going to understand. So if it is more than 50%, then it becomes an associated enterprise. So that's what we are going to discuss in the answer. As far as the answer goes, Delta Limited, as we said, is a deemed associated enterprises or deemed to be associated enterprises since to former constitutes 51.33%. So they're applying this 350 crores into that 88, dividing it by 60,000 crores. The proportion is 51.33%. So this 51.33%, since the loan advanced is not less than 51%, which is nothing but it is more than 51%. Since the loan provided is more than 51%, then the two companies are deemed to be associated enterprises. So this is what you're actually calling it as the relationship. So it is classified as a deemed associated enterprises under section 92B. Moving on, we said since it is automatically the deemed associated enterprises, and considering that the loan transaction is an international transaction as per the definitions under section 92B, since it is an international transaction, since it is happening between a non-resident and resident, it is automatically categorized as international transaction. Accordingly, transfer pricing provisions would get attracted in this case. So that's the first question. So the first question that we discussed was whether transfer pricing provisions are applicable or not applicable. So this is what we have answered now. The second question, that is the second question, is basically whether anything has to be done with respect to transfer pricing provision. That is, they have already, there is primary adjustment has been, should primary adjustment be provided? So should primary adjustment be provided in the books of account? So we discussed about what is primary adjustment. What did we say? What did we say? We say whenever there is a difference between the book pricing and the arm's length price. So in our example, we said there is a transaction which is around 50 crores, whereas your arm's length price is 60 crores. 10 crores can be adjusted suo moto, voluntarily. The assessee can adjust in the books of account, or the transfer pricing officer can also adjust. So this is what we are calling as primary adjustment. So where the loan advance, so how do you actually determine the arm's length price? How do you determine the arm's length price? Typically, you will have to introduce a particular method. That is, you'll have to find out which is the most appropriate method. There are 6 methods. You have comparable uncontrolled price method, you have cost plus method, you have resale price method, you have profit split method, you have transactional net margin method, and finally other method. So of these 6 methods is what you are calling, you will have to choose one method to determine the arm's length price. So if you actually see in the question, they have given us a comparison. What comparison have they given? They have said the same company, that is the Alps Inc. itself, has given a loan to another entity, has given a loan to another Indian entity itself. At what rate? At 7% per annum. But what is it? It is offered to Delta Limited. It is offered at 9% per annum. So the difference between 9 and 7, that is 2%, is excess. That is, it is above the arm's length price. The arm's length price is 7%, whereas they have actually levied 9%. So the 2% is what you're calling as primary adjustment. So this primary adjustment is what you have to provide it in the books of accounts. So how do you compute that? The total loan amount. What is the total amount? It is euro 350 crores. Per value is 88. The book is, the question itself provides you a number, which is 88. So 350 crores into 88 comes to 30,800 crores. 2% on 3,800 crores. How much is it? It is 616 crores. So this 616 crores is what you are going to discuss as primary adjustment. So now what will be the revised total income of this particular company, that is Delta Limited? They already have 2,100 crores. Now you need to add 616 crores. So put together, you get an income of 2,716 crores, correct? So this will be the revised, that is your taxable income. When your income is 2,100 crores, you are adding primary adjustment under section 92C, that is 616 crores, which totals your total income as 2,716 crores. So this will be your total income after primary adjustment. Now, since primary adjustment has been provided in the computation of income, secondary adjustment needs to be provided in the books of account. Primary adjustment is for income tax purpose. Secondary adjustment, you will give impact to the books of account. So books of account, what has to happen? Now, typically, I have paid 616 crores extra to Alps Inc. Alps Inc. has to give back the 616 crores. So you'll have to book a receivable entry in your books of account. So that is what is called a secondary adjustment. So since it has already been made by suo moto, they'll have to carry this secondary adjustment. So what does the secondary adjustment need to make? They need to recover the 616 crores lying with the Alps Inc. So what is the period in which they need to recover? They'll have to recover this within a period of 90 days. So that's the time limit for recovering it. So 90 days from when? 90 days from when? From the due date of filing return of income. So what is the due date for filing of return of income when you have transfer pricing? The due date of return of income when you have transfer pricing is 30th November 2022, because we are talking about the financial year 31st March 2022. The due date for transfer pricing cases under section 139(1) is 30th November 2022. So this is the actual limit. So this is what you will have to recover within that date. That is 90 days from 30/11/22. So what is the 90th day? So if you actually see 3 months, right? So it is December, January, February. So you'll have to recover before 28 February 2023. If not, what happens if not? There are two interest specified. If it is an Indian currency loan, the SBI rate, the lending rate of State Bank of India, plus 3%, plus 3%. In case if it is relating to your LIBOR related rate, so 3.25%. If it is related to LIBOR, that is if it's of exchange external commercial borrowing, that is borrowed in foreign currency, then 6-month average LIBOR as on 30th September of that particular year. That is the relevant assessment year. So that this 30th September 2022 will become the period on which you'll have to take the rate for 6-month LIBOR plus 3%. So plus 3% is what you need to add it along with that. So this is the rate. So if it's an Indian currency, it is State Bank rate plus 3.25%. If it is LIBOR rate, if it is 6-month LIBOR on 30th September of that relevant assessment year, plus 3%. So this is what you need to take as the relevant rate. So since the loan is denominated in euros, you will have to adopt this particular LIBOR plus 3%. So what is the interest period? It is from 30th November to 31/3/2023. That is, it is an assumption because till that financial year, we are assuming that till that financial year, it is not recovered. If required, you can even calculate it till 20th February, saying that it was recovered in the month of March. So it's just an assumption. You can go again in the way you wanted in the books of in the examination, but the preferred assumption is it is not recovered even till 31st March. So you are calculating this 4-month interest, that is December, January, February, March, 4-month interest at LIBOR rate, whatever it is, plus 3%. So this will be applied on that particular 616 crores to identify what will be the income. So that is the thing. The last question, can Delta Income Delta Limited pay any additional taxes for regarding the secondary adjustment? Now, what if I say, see, Alpsinc is not going to give me the 616 crores. They're not going to give me back the 616 crores. So I'll have to do some other adjustment. So what do I do? Rather than accounting for all these interest and other things, there is a straightforward way provided under section 92CE. 92CE says, see, if you're not able to recover it, if you're not able to get back the money from your group entity, the deemed associated enterprises or the associated enterprises, you pay the tax on that amount. Had you received the 616 crores, you pay the tax whatever it's due to the government. The rate is provided. The rate for this particular situation, that is rate specified under section 92C is, for adjustment for 92C is tax at 18%, surcharge at flat 12%, and cess at 4%. So that will actually make it 20.9. It's a flat rate. So there is no question about changes to this rate. Depending upon your income, surcharge changes, all that is not there. It is a flat rate, 20.9664. How is this computed? 18% tax, 12% surcharge, 4% cess. All this put together on 16 crores can be paid by Delta Limited and said there is no more requirement adjustment. The second question is on a case law. Okay, so we'll first understand the situation. I'm not going to read it in specific. I'll just tell you briefly what it is trying to tell you. So there is a company in India. Let's keep it as Saraswati. There is a company in India named Saraswati. There is a company in Singapore called Kalong. Now, the Saraswati has a transaction with Kalong. When you say Kalong, it is a Singapore company. Its POEM is also in Singapore, which means it's a non-resident. So now this Saraswati has a tie-up with Kalong with respect to a particular software. So they have entered into an end-user license agreement. So Saraswati and Kalong have entered into an end-user license agreement for what? There is this particular software called a shrink-wrapped computer software. This particular software, license of using. So non-exclusive license. What do you mean by non-exclusive license? I am not giving it to you alone. It's like Microsoft license. You can also use Microsoft license. I can also use Microsoft license. Someone else also can use Microsoft license. Only thing Microsoft expects is payment. You pay for the license, I'll give you the license. So that is called as non-exclusive, which is mean it's not exclusively for me. It is a general software license, as you have for many softwares. Whatever softwares you probably could remember, every software will fall under this category unless it is developed only for you. So now it is a non-exclusive license has been provided for usage of that shrink-wrapped computer software. So it's a software. So this has been provided by Kallam to Saraswati. It has been provided through one particular computer. It is only provided for one computer, and there are agreement which says it will not be available over a network. So whenever you wanted to use that software, you open that particular computer and use that software. You cannot share it with network or something. It cannot be used with multiple computers. So it's a single license only with one particular computer. It's like your Tally single user license. If you have probably been using Tally during your articleship days, you probably know that there are a couple of licenses in Tally. One is single license, another is multiple user license. What is single license? It is only for one system. So it can be used in one particular system. What about multiple user? It will be available network. Anyone in the office, your seniors, juniors will be also able to use if they are in the same network. So this software, whatever this Saraswati has purchased, whatever Saraswati has got license, is basically this single user license like a Tally license. It's not a multiple license. So this one thing, so that is what they're saying. So that is what is available is only one copy. Whatever is there is available. So now the question comes. So basically, Kallam, that is the Singapore company only, reserves all the rights. So basically, what is restricted to Saraswati is only usage of software, nothing else. So what it can do is it can use the software in that one particular system. Now, this whatever we are talking about, that is this Saraswati is protected by the copyright and intellectual property laws and treaties. So basically, whatever Saraswati is handling is a particular product which is already protected under the intellectual property rights in that particular. So Kallam completely owns. Kallam only owns the intellectual property. It is a property of Kallam. Saraswati is only got the license to use. So it is only license. It's only for use and not for any other purposes. Typically, you can remember something like Tally or something. You get the Tally, you get the license to use Tally. Just because you have a license of Tally doesn't mean you have the ownership to do anything with respect to Tally, right? So what you get is only the usage right, and it's no other purpose. And it is not actually sold. This is a very key word, right? So when you say sold, what is actually happening is not selling. It is just a user license, a grant of license provided for the purpose of using. You don't own any other right. You don't own any ownership on that particular software. You're just having the right to use. So this is what is called as this end user license agreement. So that is what they're said. So this Saraswati does not have any other thing. So it cannot recreate that software. It cannot reverse engineer. If you probably reverse engineer, is now you have the software in hand. You understand what could have actually been gone behind the creation of that software. You create a duplicate version of that software. So the Saraswati does not have any rights of such things. Only thing that they have is right of using that particular thing. So this is the overall background. So let's not read it word by word. So typically, let me just repeat the background. Saraswati has purchased a license to use a software from Kallam. Every rights is reserved only with Kallam. That is the intangible, the intellectual property rights, the copyright, everything lies only with Kallam. What Saraswati gets is use of that particular software in one single system. Nothing else apart from that. It cannot copy, it cannot recreate, or nothing of that kind is available. Now, what happens? So now what happens? We'll go to the actual question. So now, based on the above terms of ULA, the provisions of Income Tax Act and India-Singapore DTA, of course, let me just stress this in your question paper. Whenever a question is related to a DTA, the relevant extract of the DTA will preferably be given in the particular question itself, because you are not supposed to remember the clauses of DTA. It is not part of your syllabus at all. So what is required is you will be given an extract of that thing. You can read through and understand. And even more, to make it simple, let me just tell you, any question that is being asked in this particular chapter of international taxation, it will be based on only content that is provided in your material, including the case laws provided in your material. And there are hardly any too many number of case laws. Probably any case laws that has happened in 2021, that is a year before, that is what is only covered in your institute material. There will be hardly very few cases, so you can go through that. So your question, if based on that case law or general understanding of the provision, you will not be tested beyond a point. So just have an overall understanding of what treaty does, what are the provisions that are applicable from the perspective of Income Tax Act. Broadly, what are the provisions available in the treaty? Don't go beyond that. Just have a basic understanding. And now the question says the relevant extract is provided. Now we need to understand what is the tax scenario here. So what happens, whether this can be considered as payment of royalty and accordingly treated. So what do you mean by royalty? You pay money for using something, right? So you pay money for using something. So now this Saraswati is paying money for using this particular software. Now can we say this is also royalty? So this is what we are going to discuss and understand the provisions, the tax deduction required under section 195. So as I said, this was based on a recent case law. This was also discussed in the session. If you actually could go back to this particular session in your learning session, in your LMS, you could probably find that this case was discussed in detail. So the same question is what we are discussing here. So there is this Engineering Analysis Center of Excellence Private Limited versus Commissioner of Income Tax. So this was discussed in Supreme Court in the year 2021. So in this particular section, the Supreme Court first came out with the understanding of royalty from Income Tax Act. Any court or any understanding for interpretation, the first step is to understand the provision from our own Income Tax Act. Only then you'll have to go to the treaty. So now we are seeing that what does Income Tax Act provides about royalty. So explanation 2, clause 5 provides royalty. What do they provide? It says, what is royalty? Royalty is basically transfer of all or any rights, including the granting of license. So it also includes license, okay, in respect of any copyright, literary, artistic or scientific work. So this is what you're coming. So it including granting of a license. Now, further, as per explanation 4, so there is another explanation which says transfer of all rights includes what? Includes computer software, including license. So now, if you actually stop here and understand the provision, whether this transaction is royalty or not, under section 9, subsection 1, clause 6, yes, it is a royalty, because royalty here includes granting license of a computer software. Now what happens? It automatically should be treated as royalty. But as per the meaning assigned in DTAA with Singapore, what does royalty means? It is use of, right to use any copyright of literary, artistic or scientific work. Here, the word of license is not specified. The word of computer software is not specified, as we have in section 9.1, clause 6. Now, what did the court say? The court said, see, the computer software is purchased directly by an end user license agreement, end user from a non-resident. The end user does not create any interest. So by just signing that agreement, I don't create any ownership on that particular thing. So I don't create any interest or right which should amount to right to use of any copyright, because the end user very clearly says you cannot copy the software, you cannot reverse engineer the software, you cannot copy into another system, you cannot use it in the network. See the number of restrictions that are placed in the end user license agreement. So when you talk about the interest or right created, there is nothing that is actually created. The license that is granted via the UELA is not the license in terms of Copyright Act. When you say license per Copyright Act, you get a sense of ownership. you kind of get the ownership of that particular thing. That is where the license of copyright provides. So Copyright Act says, if you are providing license to someone, probably they also have a kind of ownership. They are interested in that particular thing. So that is what is actually called as a license, transferring a license. But here, it is a mere usage license. There is nothing beyond that. So it says, but a license which imposes restrictions or conditions. So when a license gives this many conditions and restrictions, when there are so many restriction conditions, we need to understand difference between just a right to use and right to reproduce. Right to use and right to reproduce. So this is what is being specified here in question 2 and said, because of that said, it is not a royalty for the use of copyright in the computer software. So whatever is provided is only right to use and not right to reproduce. Whatever DTA provides is about right to reproduce, not about right to use. So that's what they said, and they said it cannot be considered as a royalty under DTAA. Now, income tax says it is it's a royalty. DTA says it's not a royalty. What do you follow? Let's again refresh our international taxation portion. We said whenever there is a difference of tax treatment between Income Tax Act and the DTAA, what will be applicable to the assessee is which is more beneficial to the assessee. So this has been designed, this has been specified under section 90. 90 says whenever there is a difference of tax treatment between the Income Tax Act and the Double Taxation Avoidance Agreement, whichever is beneficial to the assessee can be followed, whichever is more beneficial to the assessee. So in this case, since India has a DTA with Singapore and the DTA is more beneficial, the term royalty assigned in Singapore is more beneficial. That will be applied. That will be applied, which means it is not a royalty. So they said, since it is not a royalty as per the DTA, we need to ignore whatever is provided in section 9(1) clause 6. So that's what is there. So this is not a transaction which is subject to royalty. So that's the conclusion. So there is no requirement of TDS and other things. So the same does not give any income that is chargeable to tax in India, since the provision of DTA are more beneficial, because whatever is entered is only a end user license agreement. So we are first discussing the fact, we are discussing the case law, what it conveys, we are discussing the provision of the case law. Finally, we are concluding saying that it is not royalty. So this is the structure of answering a question. Depending upon whether it is 4 mark or 8 mark, your structure changes. Basically, you cover the fact, you cover the provision, you cover the understanding, what you have understood, and finally concluded. So this is the general structure of a particular thing. Here, we have discussed about the case law, the provisions, our understanding, and finally we are concluding. So that is, we'll move on to question number 3. So what is question number 3? It is about a computation. So basically, he's a resident Indian who is 61 years. So once age is specified, once it says that he is a resident, he becomes a senior citizen. So they have given a various income. He has also earned income from country P and country Q. So what is the income? So we'll just move on with that. So it is profession of 11 lakhs. Agriculture income in country P is 75,000. Dividend is 2,20,000 in that country. Royalty income from P. Expenses incurred royalty. And then there is a business loss in 72,000. Whenever you're reading a line, immediately try to remember what portion it is we are talking about. We need to see how the treatment of agriculture income. In India, agriculture income is exempt. What about that particular country? Similarly, dividend. Any dividend in foreign company, it is taxable in India. And what about royalty? Are there any deductions available in Chapter 6A? Yes, you have 80 QQB, so we need to work about that particular deduction. Is this expense deductible or not deductible? What about business loss? Can it be adjusted or not? So these are the things that we need to give importance to. Now, he also has a rental income from that particular entry. So the word used is gross, which means there is no standard deduction or something provided. Whatever the country Q, the gross income is actually taken into. He has also paid a municipal tax of 9,000 with that particular in that country. So now the rule of country Q says you are not eligible to set off the business losses. So whatever business losses we have accounted here, that is your 72,000. This cannot be adjusted in accordance with the laws of country Q. But here we will go only by the whatever is a procedure here. So the tax rate in country of P is 15%, Q is 20%. Now we need to compute. One of the most important line of this particular question is India does not have a double taxation avoidance agreement with country P and country Q. So which means the section applicable is 91. 91 is the section which discusses about foreign tax credit in this particular situation where you do not have a double taxation avoidance agreement. So we'll just understand about. So the first step of this question is computing the total income taxable as per Income Tax Act. So now let's compute that question. So we have various income. So you go in that order. You have income from salary, house property, then you have business or profession, then you have capital gain, then you have other sources. You do it in the same order. So now income from house property, you take whatever is that is 3,09,000. You reduce this, you're eligible for 30% of standard deduction under section 24. So your income will be 2,10,000 of income from house property. This is the first section. Second section, he has an income from business or profession. So income from profession carried on India is 11 lakhs. He also has an income from royalty, which is also a kind of business income only from that particular country P. He has also spent 80,000. So whatever he has spent, after deducting is that 80,000 will be how much of the income? So that's 4,50,000 minus 80,000 will become your 3,70,000, right? So it will become 3,70,000. So that's also conveyed. And then you have loss in that particular country. Loss may not be allowed in that country, but here we are computing only in the loss of Income Tax Act. Business losses covered, and it can be adjusted with other business losses. So you are adjusting the 72,000 and claiming this 13.98 lakhs as profit and gain from business or profession. Then you have income from other sources. Agriculture income in country P. We do not know what is the treatment of agriculture income in country P, but as far as India is concerned, it is exempt. But when is it exempt? It is exempt only when it is from an agriculture land situated in India within the rules of that particular thing. That is within 8 kilometers, within 2 kilometers, all that ratio, right? If it's only an agriculture land situated within that parameters, only then it is an agriculture income. Only then it is an exempt. So in this case, it's a foreign land, so it doesn't fall under the exemption category. So the 75,000 is straight away taxable. You have dividend, the foreign dividend is straight away taxable. 2.2 lakhs is also taxable. Then that is your gross total income. Now, what are the deductions eligible? You are eligible for 80 QQB, assuming that he has satisfied every other condition, and assuming that he has also brought that money into 6 months, because that's one of the main conditions. To claim deduction under section 80 QQB, you will have to repatriate the money, whatever is received outside India, within 6 months. So we say that it is already bought within 6 months. So you take a claim of 3 lakhs. So it's maximum of 3 lakhs or the net royalty received. So after this deduction, the net total income is 16,03,000. Now, what is the 16,03,000? Since the adjusted, when you talk about this particular number, since there is a deduction under section 80 QQB, we need to see whether alternate minimum tax is applicable. That is, alternate minimum tax is a minimum alternate tax for other entities other than companies. So this alternate minimum tax is applicable only when your adjusted gross total income is more than 20 lakhs. What is adjusted gross total income? It is this income. It is before giving deductions in particular sections of chapter 6A. So this is your adjusted total income. Since this is less than 20 lakhs, there is no requirement of calculating adjusted gross total income. So we can automatically proceed. 16,03,000 is your total income. So you compute the tax. So being a senior citizen, up to 3 lakhs, there is no tax. 3 lakh to 5 lakh is 5%, that is 1 lakh. 3 lakh to 5 lakh is 5%. So you get how much? So you get 10,000, and then 5 lakh to 10 lakhs. On this 5 lakh, it is 20%. So it is 1 lakh. So 1 lakh plus 10,000. In total, your tax is 1,10,000 for income up to 10 lakhs. So above 10 lakhs, that is on 6,03,000, you calculate 30%. So whatever the number is, 2,90,900 becomes your tax payable on that You add health and education cess, which is around 11,636. So on this, you need to calculate foreign tax credit, deduction eligible under section 1991. So what is the rule? Compute tax rate of Indian income, compute whatever is the tax rate of the other country, whichever is lower is eligible for a deduction. So we are going to do that exercise and see whichever is beneficial. Now, the average rate in India is the total tax, that is 3,02,536, whatever we have arrived here. This 3,02,536 is what we are calling as the total tax payable. This divided by 16,03,000 gives you 18.873%. This is the income tax rate as per Indian tax law. Now, what is the rate in P? It is 15. What is the rate in Q? It is 20%. Now, we said whichever is lower. In both the cases, not both the cases, in country P, it is P's rate which is lower. In country Q, it is the Indian rate which is lower. So we'll first compute the foreign tax credit for the country P. What is country P says? So the whatever is agriculture income, you take that. Whatever is the royalty income, you have to give deduction under 80 QQB also, because we are only taking what is taxable under the Indian laws. Remember this word, you'll have to only consider income which is taxable under the Indian law. You should not take the overall income. So 75,000 plus 70,000, 1,45,000. On this 1,45,000, you apply 15%. You apply 15%, you get 21,750. So this 21,750 is what you are eligible for tax exemption. Just remember, there is no cess, nothing, because at 18.873%, that is whatever we have computed here, is after surcharge and cess. So you don't do any cess calculation or something of that kind. Whichever is lower is straight away claimed as deduction under section 91. And what about the country Q's income? Income from house property is 2,10,000, which is taxable income under the Indian laws. Please remember this word. You only have to consider income which is taxable under the Indian laws. So dividend, it is 2.2 lakhs. The total is 4.3. Loss of business income is adjustable under the Indian laws. So you are adjusting 72,000, which gives you total of 3,58,000. On this 3,58,000, you compute 18.873%, because that is the lower. So 67,565. Total of 89,315 is what you are going to consider as foreign tax credit. So this is what we have adjusted here. The total foreign tax credit of 89,315. So and then the net tax payable, that is whatever is talking, is 2,13,221 becomes your tax payable. So this is how you compute foreign tax credit. You compute Indian taxable income, calculate the average rate. For that income, calculated taxable income, on that you apply whichever is lower rate between the Income Tax Act and the foreign country. So that is there. These are just some of the conditions for 91. Basically, you must be a resident. It should have been arised from another country, and it should not have been an Indian income. And of course, taxes should be paid on that particular income in that country. So, and there should be no agreement. So that's one of the important conditions. These are the conditions for you to claim benefits under section 91. That is foreign tax credit under section 91. So hope you are clear with this. Fourth question. Examine with reasons whether two enterprises or whether related parties or not related parties. So now this question talks about whether a particular entity is a related party, or that is an associated enterprises or not an associated enterprises. So this is what we are going to see. So as we said, when is someone called as an associated enterprises? They are called as an associated enterprises whenever either there is some influence on management, control, or capital. If there is some influence on one of these three, they become associated enterprises. If the control is not there, that is, if there is no influence on management, control, or capital in all these three situations, then automatically it will be considered as not associated enterprises. So that's the first thing. But apart from this, we saw there are so many categories of deemed associated enterprises based on payment of royalty, based on purchase of raw material, based on the quantum of loan, based on the guarantee provided, based on appointment of directors. So all this is what makes whether a particular entity is whether that entity is deemed to be an associated enterprises or not. So this is what we are going to see some of the situations provided here. So we are talking about PQR Inc., which is a US company. It has its place of effective management in US. Why is this important? Why is this important? Because in the country, like if it's a foreign company, if POEM is in India, they become a resident. Once they become a resident, probably the transfer pricing provisions might not arise also, we do not know. So it is important that the transaction, either or both of them are non-resident. If both of them are resident, then transfer pricing does not get attracted unless it falls into the specified domestic transaction category. Now, they have advanced loan 170 crores to Maganadi. So the PKR US company has lent loan of 170 crores. Book value is 300 crores. So book value of this 300 crores, 50% is 150 crores. 51% will be somewhere around what? 153 crores or what? Something like that. So if your loan provided is more than this 153 crores, it automatically becomes an associated enterprise. It's deemed to be an associated enterprises. They've also given the market value of asset. See, this is where the question tries to confuse you. Now you will start rethinking. What is the provision? Does the provision say book value or does the provision say market value? You will start questioning yourself. You will start questioning yourself on the knowledge that you have developed while learning these provisions. So sometimes questions does confuse you. So typically, the word used in the provision is book value. It is not giving you any other terms. So what we need to consider is only the book value. And they also say that Maganadi repaid 30 crores in that is before 31/3/2022. They have repaid this 30 crores. So the question is concerned here is whether this 30 crores should be adjusted with 170 crores or not. Now, if you actually see the provision, it says loan provided to an enterprise is more than 51% of the book value of asset on that particular year end. So now the question is not about whether it is repaid or not repaid. In case the loan is provided, it has to be considered. This has to be considered. So this is what is there. So what does the thing say? PQR, a foreign company, which is around 56.67% of book value of assets. So they are considered to be deemed to be associated enterprises under the transfer pricing regulation. So that's the answer for the first clause. What is the second clause? Again, it's Queensland. Its poem is also in France, which means it is a non-resident. So now this non-resident company, that is Queensland PLC, has the power to appoint 3 of the directors of Godavari Limited. So how many directors are there more? In total, there are 8 directors. So now what does the provision 92A says? It says at least half of the directors, that is half, right? So 1/2. At least half of the directors are appointed by another enterprise. So for Godavari Limited, if another enterprise is appointing more than half of the directors, then it becomes 10. So in this case, it is 8. Half of 8 is 4. So more than 4. So what do you mean by more than 4? At least 5. Only if at least 5 directors are appointed by Queensland PLC, it cannot be called as an associated enterprise. So here what has been appointed is only 3. Right? So Queensland is appointed only 37.5%. That is 3 out of 8. So in this case, whatever has been appointed is less than 50%, less than half. So what does the provision say? If more than half of the board of directors, more than 4. So here it is only 3. Hence, they are not called as deemed to be associated enterprises. So they are not deemed to be associated enterprises. So hope you are clear with this. So we'll move on to the last part of this question. There is a total value of raw materials, right? So we said, we were just saying that what all is probably considered. One of the things that is considered and deemed to be associated enterprises, quantum of purchase of raw materials from one particular entity which determines the pricing policy. So the proportion that I've given is 90%. So if more than 90% of raw material is purchased from one entity, which determines the pricing, they become a related party, even though they do not have any influence on management, control, and ownership. So even in that case, it will be still called as an associated enterprises. So what does it say? Here it says an Indian company, again Saraswati here. Saraswati is around 900 crores. That is total value of raw materials is 900 crores. So of this, supplies to the tune of 830 crores are only from one particular entity, that is Joel GmbH, which is a German company having its poem in Germany, which means it's a non-resident. So now, what is the scenario? Whether they will be treated as associated enterprise or not. So 900 crores, 90% is 810 crores. So if the purchase has been made more than 810 crores, then automatically it becomes deemed to be associated enterprises. So since Joel GmbH, a German company, supplies 92.22, how do they arrive at 830 divided by 900? So that is how you calculate this 92.22. Since it is more than the threshold of 90%, this is a keyword here, and the prices are decided by German company. So in this case, both the entities will be called as the deemed associated enterprises. So that's what this provision is about.